Hi, in this video I'm going to explain the concepts behind delta neutral strategies in DeFi, show some detailed examples, and walk through a couple of platforms that can employ these strategies. I aim to make this a standalone video so that someone could watch this and get a decent understanding, but a couple of good videos to watch before this would be my videos on short farming and yield farming APRs. I'll link them in the description below. Of course, I'm not advocating for or against these strategies, and nothing in this video constitutes financial advice. Always do your own research. Alright, let's get started. Alright, so what exactly is a delta neutral strategy? So in plain and simple terms, it's a strategy that makes money, potentially, regardless of upward or downward price movement of some underlying asset. And that can be done by having positions that bet on and against the same asset at the same time. So in a delta neutral strategy, there is always some type of asset that I am short on, and that involves shorting an asset, which means betting against it, and this is called the short position. It also involves some sort of long position on the asset, which means that I am betting that the asset goes up in price. So a combination of these two things is inherently fundamental of a delta neutral strategy. Why would I want to use a delta neutral strategy? Well, it gives a decent yield on investment without having to predict the price movement of some asset, or if I think the asset is not going to go up or down in the foreseeable future. So it's just going to trade sideways. And this is a relatively low risk, but it's not without risks. So let's take a look at what some of those are. The risks are, but are not limited to, liquidation. So anytime that a short position is opened on an asset, there is some borrowing involved. And whenever there's borrowing of an asset, that means in DeFi at least, there has to be use of collateral. And when the collateral moves in price such that the protocol or the platform that we've borrowed from doesn't think we can pay back the loan, then it's at risk of liquidation. Because there's this risk, it's wise to monitor the strategy if the underlying asset of the delta neutral strategy is a volatile one. There's a risk of potentially impermanent loss, and that's if any type of yield farming or liquidity farming is utilized in the strategy. Impermanent loss might reduce the delta neutralness of the strategy. So maybe the entire strategy might be in a net short position, or the entire strategy might be in a net long position. It depends. And finally, price fluctuations in rewards tokens. And this is kind of coupled with the impermanent loss in that if we are providing liquidity in some yield farming position, then those pool APRs are probably dependent on the platform's reward tokens. So if those reward tokens change in price, then the APRs might change, and that's going to affect how much return we get on the delta neutral strategy. All right, so here are two types of strategies that I'm going to talk through. The first one is a short farm plus a long hold, and I'll explain what these mean. And this is the pure neutral strategy, meaning both the long and the short positions will always cancel out perfectly. As far as I know, this only occurs on Mirror, the Mirror protocol of the Terra blockchain. And Mirror is a protocol in which I can buy synthetic assets like stocks. So there could be a tokenized version of Tesla stock. I can buy that token, or I can short it. So I can do both of those things on the Mirror protocol. And a short farm on Mirror protocol, all that means is I've opened up a short position by borrowing some synthetic asset, and then I'm selling it immediately, but at the same time, Mirror is giving me farming rewards from liquidity pools. So that's the short farm. And then the long hold just means whatever synthetic asset I'm shorting, I'm also buying the same amount at the same time that I've opened a short position. And I'll go through this in detail in the next slides, but that's essentially the gist of this short farm plus long hold, pure delta neutral strategy. This type of strategy is not exposed to impermanent loss, and the collateral that I'm using to borrow the synthetic asset is earning interest because it's utilizing the Anchor protocol, which is the savings platform on the Terra network. And finally, it's also earning liquidity farming rewards, but only at 33% of the position. The next type of delta neutral strategy is a short farm plus a long farm, which is, it has many names in DeFi. Another name is neutral hedging, and that's been coined by Francium protocol, the Francium platform. All of these are pseudo delta neutral strategies because the long and short positions don't end up canceling out 100% when we close out the position. It's possible that there's a negligible or very small effect of the price action of the underlying asset. in the returns. So that means the price movement of whatever underlying asset that we're performing this delta neutral strategy on, it has a very small effect on the returns that we get back. So the platforms for this strategy is Mirror. Mirror has a version of this, and then everything is kind of tweaks this type of overarching strategy. So Francium, which is a leverage yield farming protocol on the Solana network, has an automated version of the Pseudo delta neutral strategy. I believe you can also manually do it on Alpaca Finance and other leverage yield farming protocols. So in this strategy, I am exposed to impermanent loss, and the collateral that we are using may or may not be earning interest. In the case of Mirror, it will be. In any other case, if I'm manually borrowing some token with collateral, then that collateral could potentially still be earning interest. It all depends. And finally, is it earning liquidity farming rewards? The answer here is yes. That's the whole point of this strategy, is to not care about the price action of whatever tokens is in the pool. I just want the liquidity farming rewards. That would be the point of this strategy. Okay, so let's go through the first pure delta neutral strategy on the Mirror protocol. And just to reiterate, this is a pure delta neutral strategy, meaning the long and short positions will always cancel out, and the price action of the underlying asset does not matter in this case. And this is a graphic that I modified from Aperture Finance, which is an automated strategy protocol on the Terra network initially. I'll be doing a later video on them as well. For this strategy, assume that I start off with 90 UST. Now I'll be splitting that into 60 UST to deposit on Anchor. And then I will, for the rest of the UST, I will immediately purchase some synthetic asset, whatever synthetic asset that I feel like has a good return on the short farm. In this case, let's just say M Square or MSQ. Square is the company. And I'll immediately buy $30 worth of M Square on Mirror. So the initial step is I've deposited $60 worth of UST on Anchor in order to get back 20% in APY. And then for my long position, I am buying $30 worth of M Square and just holding it. So this branch of the strategy is the short position, and this branch is the long position. As I move forward in the strategy, I'm going to go through the short farm section first. So using the AUST, which is the receipt token that I get back from Anchor Protocol for depositing my 60 UST in there, that is worth $60 in value, and I can use this AUST as collateral to open up a M Square short position on Mirror Protocol. And that just means I'm using the AUST as collateral while it's earning interest, and I'm depositing onto Mirror so that I can borrow some M Square. And I can only borrow up to $30 worth of M Square because of the collateral ratio on Mirror Protocol. That's just the safe ratio in which liquidation is not likely. If I have $60 worth of AUST, then I can borrow up to half of that in order to be safe. The next step is to then participate in the short farming on Mirror Protocol. And what that means is just to complete the smart contract such that I get back an M Square SLP token, which is a short LP token. This just means I have some right to the liquidity pool trading fees of the M Square UST pair. If I own this SLP token, I can get back trading fees from that liquidity pool without exposing myself to impermanent loss. Finally, after 2 weeks of participating in the short farm, what the Mirror Protocol allows me to do is then use the $30 that I would have gotten by immediately selling my M Square shares and giving that back to me so that I can do whatever I want with it. I have to wait 2 weeks before getting this UST back, and once I get it back, then I can deposit it on Anchor to earn even more interest. So effectively, I have $90 worth of UST on Anchor accruing interest. Now finally, this completes the pure delta neutral strategy on the Mirror Protocol. So in the long position, all I'm doing is just holding $30 worth of M Square. And in the short position, I owe Mirror Protocol $30 worth of M Square. And because these positions were opened up at the exact same time, they are the same amount of M Square shares that I'm holding in the long case and that I owe in the short case. So because they cancel out, that is what this pure delta neutral strategy means. And what I am getting back is the passive income from the Anchor protocol, in which I have now deposited 90 UST in this step and in this step. So I'm getting 20% on that. And then as I'm holding the SLP token, I'm also getting trading fees from the liquidity pools back in the form of APR. So those are the sources of return and sources of profit that I'm getting from this strategy. The returns I get from this strategy is independent of whether or not M squared goes up or if it goes down. All right, I'm going to quickly go through how the pure delta neutral strategy works on Mirror Protocol step by step. And there are lots of videos on YouTube that go through this, but I'm just going to show it here just for completeness. So I want to go to the farm page and I want to look for a short farm that has an attractive APR. I'm just going to pick MApple here, click on short farm. And at this point, I've already deposited some UST on Anchor. So now I'm holding a UST in my wallet that I can use as collateral. So I'm going to select a UST here. And then just like the example that I've shown, I'm going to deposit 2/3 of my initial capital that I want to invest on the short position. So that in the example was $60 worth of UST, and if I convert that to AUST, that's about 49 AUST. So for the collateral ratio, I'm going to leave it at 200%, and remember this is the ratio of the collateral to how much I'm borrowing. This will allow me to borrow 0.177-ish shares of MApple that Mirror Protocol is going to immediately short, which means they're immediately going to sell those shares and get back UST. So the confirmed return UST is about 33 UST, and that will be unlocked for me after 2 weeks. And this 2-week period is here just so that the Mirror Protocol platform is protected and that they're making sure that people don't immediately buy back the shares. I think there is some error with this only available during market hours. The market is currently open, so I don't know why I'm getting this error. But ideally, I would click farm, and that would open up a short position on MApple that is worth 30 UST. And the last step is just to go to trade and use the last third of my capital that I'm trying to invest and go to buy roughly 33 UST worth of MApple shares. So I want this amount of shares to be the exact same that I've borrowed and shorted in the short farm. And I would just go ahead and click buy. And so then at the very end of this, I will be holding this amount of MAsset shares in a long position, and I will have opened up a short position with the same amount of shares, and I'm receiving short farming rewards from the MApple UST liquidity pool. The long position and the short position cancel out, and ideally I'm just getting back the short farming rewards without being liquidated. So that's how this process looks on the Mirror Protocol. And if you want a very detailed step-by-step guide on how all of this works, I'll leave a link in the description below for someone else's video. So let's move on to the pseudo delta neutral strategy. And for this specific scenario, I am elaborating on a 3x leverage scenario. And typically these type of pseudo delta neutral strategies are done on leveraged yield farming platforms like Alpaca Finance or Francium to various automated degrees. So for example, Francium, you can do it completely with 1 volt, whereas with Alpaca Finance and others, you will likely have to do some of these steps manually. So I'm using a 3x leverage scenario because the numbers work out pretty nicely. But if it was a 2x leverage scenario, then the numbers will change slightly. Imagine that I have 400 USDC to begin with to invest. I'll be splitting that up into 100 USDC in the long position and then 300 USDC in the short position. And as I explained through this example, it will make sense why they're split in such a way. 75% of my initial investment goes to the short position and 25% goes to the long position. So I'm going to walk through the long position first. What I'm going to do with the 100 USDC is to borrow 2x that amount. So I'm going to borrow 2x USDC with my 100. So that means At the end of borrowing, I'm going to have 200 USDC, which was borrowed, plus 100 USDC, which I put in. And to move forward with the long position, I immediately use 150 USDC to buy Ethereum. And I'm just going to use Ethereum as the example underlying asset in this case, but this could be any other token or any other coin. Using the borrowed USDC, I buy $150 worth of Ethereum right away. This effectively opens up a leveraged long position on Ethereum because as Ethereum goes up in price, I can sell it, get back the 150 USDC, and pocket the difference. At the very end of this position, I have $150 worth of Ethereum plus 150 USDC. And because I've used 150 USDC to leverage on the Ethereum, my long position is $150 long Ethereum. So that is the value of this long position. Okay, let's move on to the short position and how that's constructed. So I have 300 USDC here, and I'm going to use that to leverage 2x and borrow $600 worth of Ethereum. So in total, I have $600 worth of Ethereum and 300 USDC that I put in. I'm going to use that Ethereum and immediately sell $150 worth of that to open up a short position. And this is because I've borrowed Ethereum and immediately sold it in hopes to buy it back later at a cheaper price. That means I'm betting that Ethereum goes down. So that is the short position. At the very end of this, what I have is $450 worth of Ethereum plus 450 USDC. That results in a $150 short Ethereum position because I sold $150 worth of ETH immediately. At this point in time, if I do nothing else, these two positions that I have are entirely purely delta neutral. That's if I don't do anything else. No matter if Ethereum goes up or if Ethereum goes down, I remain delta neutral. And the reason that the end positions, no matter in the short or in the long, have equal ratios of ETH and USDC, that is because I'm going to then put both of these positions and deposit them into an ETH USDC liquidity pool. So that is the next step. I have both of my positions at a 50-50 ratio of ETH and USDC, and I deposit them into an ETH USDC liquidity pool. And the point of doing this is to get back the trading fees from the pool. So whatever APR that I'm going after, I deposit my long and short positions into the pool, and then all I have to do is wait and monitor the position as I'm collecting trading fees in the form of APR. That is the source of profit of this strategy. And ideally, if Ethereum does not move in price relative to USDC much, then this strategy is close to delta neutral. However, if it does move a lot, then this is where the pseudo delta neutral comes in. Because there may be impermanent loss in this pool, depending on whether or not Ethereum goes up or down, I may get back different amounts of Ethereum and different amounts of USDC than I put in. Due to those different amounts, I might end up with a less long position here, or I might end up with a less short position here. So because of that, when I close my position, these two long and short positions may not perfectly cancel out. So I might end up with a $140 short ETH position and a $160 long ETH position, which don't cancel out. That is why, due to the model of the liquidity pools and impermanent loss, that's why this is a pseudo delta neutral strategy. So in summary, this is the pseudo delta neutral strategy in which I open up equivalent long and short positions on some underlying asset like Ethereum and use leverage to deposit both these positions into a liquidity pool. And my idea is that as long as I have both of these positions, I remain somewhat delta neutral. I don't care what happens to the price movement of Ethereum. I'm just sitting here collecting the trading fees from the pool. That is the whole point of this strategy. Okay, let's take a look at a real-world example of the pseudo delta neutral strategy on Francium. So this is one of the platforms where I can automate the entire process that I just described on the pseudo delta neutral strategy using leverage yield farming. So if I go to farming strategies here, there are two that are available with the underlying assets being Wormhole ETH and USDC. And same thing here, they're just using two different platforms to do this farming. So I'll click in here. And it gives a description of what the strategy is about, what the APR is. So the APR is 25.33%. That is the return from providing liquidity to the liquidity pools. Here are the underlying assets. And here's a description of the strategy, which is a market neutral model combined by taking both a long and a short position in the asset at the same time. And then this position explanation is exactly what I have described previously, using a 400 USDC initial deposit. 100 of that will be leveraged to go long, and then 300 of that will be leveraged to go short in order to create two equal and opposite positions. And if I wanted to invest, I would just click invest, deposit my USDC, and then click invest. But I don't have any USDC on this blockchain, so I'm not going to do that. But it's just as easy as that. You click it, it automates all the steps into creating the long and short positions, and then all you have to do is monitor the position and the Ethereum price. While my funds are deposited in the pool, I just have to monitor the APR and collect trading fees based on this APR. Keep in mind, this APR is always fluctuating, so it might go up, it might go down, and that will affect the return on my investment. So in this section down here, it has a table based on this specific strategy, and it tells how much potential profit I can gain based on first how long I'm in the pool. So this column says if I'm in the strategy for 10 days or 30 days or 90 days, or these are the return on investment percentages I would get back. And then on this axis, this is how much my returns will be based on how the Ethereum has moved in price. So if it dropped 30%, then these are return on investment I can expect. If it goes up 30%, these are the return on investments I can expect. And then if it doesn't move in price within the time that I'm in the strategy, then these are the return on investments that I can expect. And keep in mind, this is a simulation. This is assuming that the APR of the pool stays constant. So in this scenario where I am deposited and invested for 30 days and the pool APR is about 25%, then if Ethereum doesn't move in price, after 30 days, I'll have returned 2.1% return on investment on my initial principal. If Ethereum has dropped 20%, then I pretty much break even. If Ethereum has gained 26-ish%, then I'll have broken even. And then anything outside of that, I'll have lost some money. But if you go out all the way here, it's highly unlikely that that Ethereum might drop 40% within 30 days, and even if it did, I would just lose about 6% of my initial investment. I can play around with this to see how investing in a longer time frame, how that would affect my profit. So if I increase it to 90 days, I'm much more likely to return a profit because I'm staying in the strategy longer, and I'm getting more and more trading fees back as rewards, as return from the liquidity pool. I just want to stress that this is highly unlikely because the pool will probably change its APR as time goes on. So realistically, at 1 year of invested in the strategy, it says there's no way I would lose money, but that depends on a constant APR from that liquidity pool. So highly unlikely, but it's interesting to see what you can potentially theoretically gain. So that's it pretty much for this Francium pseudo delta neutral strategy. All I really have to do is click invest and then deposit my funds, and then I'm just monitoring the position. I can get liquidated, so I just have to be careful about that. If the price movement is too fast and too large in a short amount of time, then that's a potential outcome to get liquidated. And Francium is one platform in DeFi that automates all these steps. Aperture Finance is another platform that's coming online on the Terra network that's going to automate another delta neutral strategy on the Terra network using the Mirror protocol and Anchor and things like that. Let me know if you have any other platforms that do these automated delta neutral strategies on DeFi. Let me know in the comments below. And that's it for this video. If you enjoyed it, please let me know by liking the video and subscribing. If I didn't communicate the ideas and concepts clearly and easily enough, please let me know in the comments below. I will try to do better next time. Let me know what you think about delta neutral strategies in the comments below. And as always, stay safe, and thanks for watching.